So in this video, we're going to talk about inefficiency. What is an inefficiency? Basically, an inefficiency is a gap between the wicks. So for example, we got here three candles. First one, second one, and the third one. And you can clearly see that from the top of the first candle wick, right over here, from the top, and the bottom of the third wick, we've got a space. And this space is a gap, and this gap is called inefficiency. So we have inefficiency, for example, when we have a strong move to the downside or strong move to the upside, and the market left some space, okay? And the market doesn't like to let space, so it will return later to fill this inefficiency, fill this imbalance, okay? So you have to understand this concept because this is pretty important, because maybe sometimes you're going to look at your charts, you see an order block right over here, but you don't see that we have inefficiency right over here. And the price sometimes is doing that reaction from inefficiency area and didn't come back to your order block. So you have to pay attention to every details. What I mean about that is if we broke that structure and this block has been mitigated right over here, and we left here inefficiency, that we know that price is going to return here and maybe don't even go a little bit to the upside because we have already mitigated that zone. So inefficiency is pretty important to the market. I'm going to show you some example on GBP USD or Euro USD, for example, and what kind of trade that you can take with this inefficiency. For example, you got here a strong move to the downside. If we take our first candle after the leg out and the third candle right over here, so I will show you right over here, you can see that we got a little bit of inefficiency. So this is not a big inefficiency right over here. You can see that here is a bigger inefficiency from here to here, and the market like to come back to these areas to mitigate this gap, okay? So you have to be very careful when you trade that inefficiency zones. They are not strong as an order block, for example. So yeah, there is a lot of inefficiency on the market, and the market is going to come back into this zone to mitigate the price. So be careful, pay attention to every details. What I mean about that is right over here, for example, we got a good sell zone that broke the structure, the previous structure right over here, and we left right over here inefficiency. So when the market is going to come back in this area, it is possible to have a first reaction right over here, and sometimes the inefficiency is too big and we didn't came back into our order block. But in this case, you can clearly see that this order block isn't mitigate. Look, we left this order block, and after that we got this move to the downside that broke the structure, and this block right over here is not mitigate. So what we're gonna do, we're gonna mark this zone and mitigate order block. So in this situation, if we see a reaction from this level, that's normal, you know. There is inefficiency on the market came back to fill the gap, and boom, made a reaction because we got a lot of orders sitting right over here. And after that, we're going to push into the unmitigated order block. So be careful, and you have to know what an inefficiency is. You got bullish inefficiency and also bearish inefficiency.